Good evening to all the students of Econ present across India. I'm Dr. C. Anirvinna. Today, to present this chapter, Exchange.
Recording in progress.
Good evening to all the students of Econ present across India. I'm Dr. C. Anirvinna. Today, to present this chapter, Exchange.
Recording.
Now, before this, I discuss this unit, I want to give a brief introduction. Right. The introduction is India's foreign exchange reserves. Right. So, which includes dollar, which includes euro, pound, Japanese yen, Chinese yuan, British pound, Canadian dollar, and Sweden Swiss franc. Okay, all these currencies are combined together 600 billion foreign exchange reserves, and majority of these foreign exchange reserves are dollars, right? So in every country keeps dollar as the major portion of their foreign exchange reserves, because dollar is the supreme currency in the world. Okay, now exchange rate, right? Why you are discussing this topic, right? Tomorrow you want to study in abroad. Right, you want to know, you want to pay the fees in US dollars, right? You should know the exchange rate, right? How much you have to pay. Okay, so you should know the exchange rate. And tomorrow you want to buy a bond or equity, or tomorrow you want to buy a land in US. Okay, or tomorrow you want to set up a factory in US. You should know the exchange rate, because, and suppose you want to import a raw material or machinery, you should know the exchange rate. Okay, should know the exchange rate. Okay, without exchange rate, how do you know that how much fees that your papa has to pay for American university, right? You should know how much you need to pay for the machinery coming from US. Suppose you're buying a car from US, right? How much dollars you need to pay? So you require exchange rate. Okay, exchange rate is required for these purposes. Okay, and foreign exchange reserves are required, right? Why every country is, now you see Sri Lanka is struggling without foreign exchange reserves. So foreign exchange reserves are required to pay for import bill, to pay debt. Okay, to pay debt means what? Debt of what? Debt of the government and debt of the firms who are borrowed through external commercial borrowings. Okay, there are many firms borrowed through ECB, external commercial borrowings. They need to pay debt. Okay, and many firms want to import machinery, they require dollars, right? Many firms want to import raw material, they require dollars. So foreign exchange reserves are very important. Okay, foreign exchange reserves are very important, and India's foreign exchange reserves are 600 billion. Okay, 600 billion. If you compare with China's foreign exchange reserves, it is 3 trillion. Okay, just imagine. Okay, just imagine the foreign exchange reserves of China, right? 3 trillion, and we are 600 billion foreign exchange reserves. Okay, foreign exchange reserves are very important, because if rupee depreciate, how can I protect the value of rupee? By selling dollars. Okay, to protect the value of rupee against the dollar also, I need to sell dollars. Where I would get the dollars? I get the dollars from foreign exchange reserves. Okay. So what we are going to learn from this chapter: why there is a need for exchange rate, define exchange rate, how it is determined, and apprise different types of exchange rate regimes, describe the functioning of foreign exchange market, explain changes in exchange rate and their impact on real economy. Okay, this is what we're going to learn. Okay, so why there is a need for exchange rate, define exchange rate, how it is determined, apprise different types of exchange rate regimes, describe the functioning of forex market. Okay, that is foreign exchange market, explain changes in exchange rate and their impact on the real economy. Okay, now look at it. Introduction. Look at it. Now, need for foreign exchange. Okay. So we need for foreign exchange arises because what? You want to study in abroad, or you want to buy a car, you want to import raw material, or a company borrowed debt from outside in US, they have to pay in debt. So our investor want to buy American company equity and bonds. So everybody needs to know exchange rate. Okay, if you know the exchange rate only, then you know how much you need to pay. right? So for day-to-day transactions with US economy, you should know the exchange rate, right? Whether you want to buy a bond, equity, land, okay, or you want to set up a factory, or you want to buy a raw material, you want to buy a car, you want to buy a machinery, or you want to study in US, you need to know the exchange rate, okay? So and so and we need to have a common currency, right? Because they won't accept rupees, okay? They accept in dollars, okay? So dollar is the common currency, because US will not accept rupees, they accept dollars. So you require a common currency to buy a land, to buy a raw material, to buy a machinery, to study abroad, or you want to go as a tourist visa to US, you require to know common currency, okay? That is dollar, okay? So this exchange rate is determined on daily basis, okay? Daily basis, okay? Okay, if you open any RBI website, or if you open any newspaper, today's exchange rate, $1 is equal to 75 rupees. This rate is determined daily basis on the basis of demand and supply. Okay, on the basis of demand supply, this rate is determined on daily basis. Similarly, petrol, diesel prices are determined on daily basis between demand and supply. Similarly, gold, silver prices and many other metal prices and commodity prices are determined on the basis of demand supply daily basis. Okay, now I told you in I told you that US dollar is the supreme currency in the world, okay? After Second World War and after the collapse of Bretton Woods system, okay? During Bretton Woods system, gold was considered to be the basis for determining the exchange rate. So now after Second World War, dollar considered to be the stable currency, and every country has to base their currency on the basis of US dollar, okay? US dollar. So this following example will make you to clear. Now look at here, US car. Okay. Now what is the US car? 10,000 rupees. Okay. Now Indian car costs how much? 9,60,000. 9,60,000. Okay. 9,60,000. Okay. Now 9,60,000. Right. So now I want to compare the prices of both US car and Indian car. The price of Indian car is 9,60,000 and the price of US car is 10,000 rupees. I want to compare the price of both the cars. Okay. Now to compare both the prices of both the cars, you should know the value of $1 in terms of rupees. So $1 is equal to 48 rupees. Okay. So we are assuming. Okay. We are assuming. So $1 is not 48. $1 is 75 or 76. Okay. We are assuming $1 is equal to 48. Right, so $10,000 means 10,000 into 48 rupees. So that US car would cost how much? 4,80,000 rupees. Okay, and what is the price of Indian one car? 9,60,000. 9 lakh. So 9,60,000. 1 0 is extra. 9,60,000. Right now, you see US car just half of the price of Indian car. Okay. US car is just half of the price of Indian car, or we can exchange two cars in place of one Indian car, or we can exchange two US cars in the place of one exchange car. Okay, so look at it. So common currency required. Okay, to require common currency, you can compare the prices of US car and Indian car. Okay, and you can say that India car is more expensive than US car because India car is 9,60,000 and US car is 4,80,000 rupees. So you can compare. Clear? Exchange rate. Exchange rate. Okay. So how one country currency gets exchanged with other country currency? Exchange rate is what? How one country currency exchange with other country currency. So there are two variants of there: nominal exchange rate and real exchange rate. Nominal exchange rate and real exchange rate. Nominal exchange rate and real exchange rate. Okay. Now what is nominal exchange rate? How many units of domestic currency required to purchase 1 unit of foreign currency? how many units of domestic, what is domestic currency of India? Rupees. So you require 75 rupees to buy $1. $1, you require 25 rupees of domestic currency. So nominal exchange rate, okay, shows how many rupees you require to buy $1. You require 75 rupees to buy $1. Okay. Now, real exchange rate. Okay. The term, when I'm saying real, okay, whenever there's a term in real in eco, it means you are considering the domestic prices of India and foreign prices of American goods. Okay. You are considering the price. If you consider the price of Indian goods and if you consider the price of foreign goods, that is USA, then we are calculating real exchange rates. So it's relative prices of goods and services in both the countries. In both the countries. What is the both country? India and USA. So it is a rate at which goods are traded. Okay. It is a rate at which rate which goods are traded between the two countries. Okay. So Mansha, why dollar is so powerful? Because for longer period of time they're able to maintain their supremacy. Okay, dollar value is stable in comparison with other currencies of the world. Okay, they're able to maintain stability. Okay, less fluctuations. Okay, dollar won't increase rapidly or won't fall. They're able to maintain stable currency after Second World War. So that is why IMF asked US. IMF has considered US dollar is a supreme currency in comparison with the other currencies of the world. Okay, so developed country, they're able to maintain stable value of currency. Okay, so no fluctuations, neither appreciation nor depreciation. Stable currency for longer period of time. That is why US dollar is considered to be the supreme currency. Clear, Mansha? Okay. So it is a real exchange rate. Is the relative price of goods and services in domestic and foreign country, that is India and US. It is the rate at which goods are traded between the countries. Goods are traded between the countries. So real exchange rate formula is equal to capital E is equal to nominal exchange rate into price of domestic goods, that is price of India goods, by price of foreign goods, that is US goods. Okay, so E is equal to small e into P upon P asterisk. Okay, small e into P upon P asterisk. Small e into P upon P asterisk. Okay, so real exchange rate formula is nominal exchange rate. Real exchange rate will be denoted by capital E is equal to nominal exchange rate into price of domestic. Yep, my Wi-Fi lost the connection. I'm connecting through mobile phone. Okay. Yeah. Sorry guys, I lost the Wi-Fi connection here. I connected through mobile phone. Please bear the inconvenience. Okay. So it is the relative prices of goods, services in both the domestic and foreign country. It is the rate at which goods are traded between the two countries. So real exchange rate E is equal to nominal exchange rate into price of domestic goods by price of foreign goods. E into P upon P asterisk. Okay. Now, if real exchange rate is high, okay, what does it mean if real exchange rate is high? Can you answer my question? Why? What is the meaning of real exchange rate is high? Okay. Can you tell me why real exchange rate high means what? Okay. Can you answer my question here? If real exchange rate is high, what is the answer? If real exchange rate is high, what does it indicate? What does it indicate? Real exchange rate is high. What does it indicate? Real exchange rate is high. What does it indicate? Can you answer my question here? Real exchange rate is high. What does it indicate? Real exchange rate is high. Okay. If real exchange rate is high, it means foreign goods are cheaper to Indian goods. Okay. Foreign goods are cheaper to Indian goods means what? Then real exchange rate high means price of foreign goods cheaper to Indian goods. It means Indians would love to import goods and services from US than buying it in India. Okay. Then what happens? Net exports will be negative. Okay. Net exports will be negative. Why net exports? Okay. Okay. It means Indians would love to import goods and services from US than buying it in India. Then what happens? Imports greater than exports of what? Goods and services. So it leads to what? It leads to imports of goods and services means what? Current account deficit. Current account deficit. Okay. Current account, it means current account deficit. It means current account deficit. It means current account deficit. It means current account is deficit. Now, if real exchange rate is low, okay, opposite. This means foreign goods are expensive and Indian goods are cheaper. Okay, so foreign goods are expensive, Indian goods are cheaper. Then net exports will be positive and current account surplus. Clear, guys? Clear, guys? So imports of goods and services more than exports of goods and services, which means current account deficit. If exports of goods and services more than imports of goods and services, then it is called current account surplus. Ayush, current account. Okay. See, in balance of payments, there are two accounts are there. Okay, current account and capital account. Okay, current account means difference between exports and imports of goods and services. Trade account or balance of trade includes only goods. Clear? Clear, guys? So in balance of payment, only two accounts are there, current account and capital account. Current account includes goods and services. Apart from this, we have a trade account, trade balance. Okay, trade balance account includes only goods. Okay, thus Now this real exchange rate depends upon what? Real exchange rate depends upon nominal exchange rate, ratio of price level of both domestic goods and foreign goods. Now we can also derive nominal exchange rate. Nominal exchange rate is equal to real exchange rate into price of foreign goods by price of domestic goods. Okay, so thus real exchange rate depends upon nominal exchange rate and ratio of price level. Nominal exchange rate is equal to real exchange rate into price of foreign goods by price of domestic goods. Price of foreign goods by price of domestic goods. Okay, clear guys. So what we discussed till now, I gave an example of exchange rate here, and what is exchange rate, simple definition I have given here. I discussed what is nominal exchange rate. I discussed what is real exchange rate. If you consider the relative prices of domestic and foreign goods, it becomes real exchange rate. So real exchange rate formula is given here. Nominal exchange rate, price of domestic goods upon price of foreign goods. If real exchange rate is high, means foreign goods are cheaper compared to domestic goods. So imports of goods and services will be more than exports of goods and services, leading to current account deficit. If real exchange rate is low, means then net exports will be negative and current account will be surplus. Clear? Now, the real exchange rate depends upon nominal exchange rate and ratio of price level, and we also derived nominal exchange rate. Nominal exchange rate is equal to real exchange rate into price of foreign goods by price of domestic goods. Price of foreign goods by price of domestic goods. Okay, and we also use two terms. Okay, direct quote and indirect quote. Okay, in trading terminus, we use two terms called direct quote and indirect quote. Okay, direct quote and indirect. Trading terminus, Mukta Vyas, nominal exchange rate means how many units of domestic currency you require to purchase one foreign currency. If you talk about real exchange rate, you are considering the relative prices of domestic goods and foreign goods. So, in trading terminals, we use two terms, direct quote and indirect quote. So, okay, in direct quote, where foreign currency, that is US dollar, is expressed in terms of domestic currency, that is Indian rupees. Okay, so indirect quote, foreign exchange rate, foreign currency, that is US dollar, is expressed in terms of domestic currency, that is Indian rupees. So under direct method, foreign exchange rate is derived by keeping foreign currency constant and rate is expressed in terms of domestic currency. So how we are able to say, today you are able to say that $1 US is equal to 75 rupees. You are keeping US dollar constant and expressing the value in terms of domestic Indian rupees, that is called direct quote. Okay, so you are keeping US dollar constant. $1 US is equal to 75 rupees. Okay, now tomorrow $1 is equal to 76 rupees or $1 is equal to 73 rupees. You are keeping foreign currency constant and expressing its value in terms of rupees. That is called direct quote. Indirect quote. So in direct quote, lower exchange rate implies. So in direct quote, lower exchange rate implies that Indian rupee is appreciated. Indian rupee is appreciated. Okay. Now in indirect quote, opposite. Okay, 1 unit of domestic currency is expressed in terms of foreign currency. Okay, 1 unit of domestic currency is expressed in terms of foreign currency. Okay, now so to express this, we are keeping domestic currency constant. To express this, we are keeping domestic currency constant. So in indirect quote, 1 unit of domestic currency is expressed in terms of foreign currency. Here we're keeping domestic currency constant. Okay, and say 1 rupee is equal to $0.0135. 1 rupee is equal to $0.0135, or 100 rupees is equal to 1.3513 of dollars. Okay, 100 rupees is equal to 1.3513 of dollars. So direct quote. Okay, you are converting dollar value in terms of rupees. In indirect quote, you are converting the value of rupees in terms of dollars. Okay. So in indirect quote, lower exchange rate implies foreign exchange is appreciated. Okay, clear, guys? So direct quote where $1 is expressed in terms of rupees. Indirect quote where opposite, we're expressing domestic currency in terms of US dollar. Now, real exchange rate, real effective exchange rate. Okay, new concept, real effective exchange rate. Okay, so we want to know how rupee is competitive. Okay, whether our rupee is competitive in the world market or not. Okay, so we want to measure the competitiveness of our currency, right? Every country wants to know whether their currency is competitive in the world market or not. So to express the competitiveness, external competitiveness of the country's currency, how competitive our rupee is externally. Okay, how competitive our rupee is in external market, external currency. Okay, so real exchange rate is calculated to measure the external competitiveness of currency. To measure the external competitiveness of currency, it is a weighted average of country's currency against a basket of other major currencies of the world. Okay, after adjusting inflation. Okay, it is weighted average of currency against a basket of other major currencies of the world, against major currencies of the world. Okay, it is a weighted average of country's currency against a basket of other major currencies of the world. What are the other major currencies of the world? Euro, Japanese yen, British pound, okay, and Canadian dollar and Swiss franc. Okay, so 5 currencies. Okay, it is a weighted average of country currency against a basket of major 5 currencies. So Euro pound, Japanese yen, British pound, and Canadian dollar and Swiss franc. Okay, after adjusting for inflation differentials, after adjusting. So if we want to measure the competitiveness of our currency externally, then we calculate real effective exchange rate. Okay, so an increase in real effective exchange rate implies that our exports are more expensive and imports become cheaper. Okay, it means increase in real effective exchange rate means that our exports have become more expensive, imports become cheaper. So exports become expensive. It means our goods and services have become expensive outside India, and imports become cheaper. Okay, it means our goods and services lost the trade competitiveness. Okay, because real effective exchange rate is high. Okay, it means our goods have lost the trade competitiveness externally because our exports become cheap, exports become expensive because nobody wants to buy our exports, right? And our imports become cheaper. Okay, it means our goods and services have lost the trade competitiveness externally. Okay, now we also calculate Mukta has direct and indirect quote is given in study material. Yes. Cross rate. Okay. Every country currency is priced in priced in terms of dollars. Every country currency, India, China, you take Japan, you take Pakistan, Sri Lanka, every country price their currency in terms of dollars. But certain countries, no, they don't consider dollar, okay, while pricing of their currency, okay, while pricing their currency, they don't consider dollar, okay. Now you take, for example, Australia, New Zealand, okay, Australia, New Zealand dollars, right? Australia, New Zealand dollar, they price each other, okay, without considering US dollar. Similarly, Euro, Pound, and Japanese yen, okay. Similarly, Europe Pound and Great Britain, okay, Great Britain Pound, okay. So these country currencies, okay, they don't consider dollar in the exchange of the currency, okay. Australian, New Zealand currency, they exchange each other based upon their currency. Similarly, Europe, Euro, and the Japanese yen, they exchange their currency, okay, without considering dollar, okay. Similarly, Europe and Great Britain Pound, they exchange their currency. It's called cross rate. Hitesh, India currency, long way to go. Okay, recently IMF basket, they accepted China as their basket of currency, right? India, long way to go as a currency to be accepted for international payment. Okay, Chinese currency is accepted of late. India currency, long way to be accepted as international payment. Okay, we long way to go. Okay, so. Okay. So there are two kinds of exchange rate regimes. Okay, so countries follow fixed exchange rate system. One second. Exchange rate regimes. Okay, exchange rate regimes. Okay. So how does a country manages their currency in terms of foreign country currencies? Okay, there are two types of exchange rate regimes are there. Okay, how does a country manages their currency in terms of foreign currencies? There are two kinds of regimes are available. Okay, so fixed and flexible, or fixed or flexible, or floating exchange rate system. Fixed or flexible and floating exchange rate system. Okay, fixed exchange system means if the value of currency is pegged against US dollar by the government of the country. Okay, so Chinese government follows this. Okay, so if the value of the currency is pegged against US dollar by the government of the country, okay, and the value will not change. They keep the value deliberately at a constant level. Okay, why they keep artificially low, deliberately constant level? This because these countries depend upon their exports. Okay, they want their exports to be competitive in the world markets. That's why they keep their currency at a constant rate or artificially low, so that their export of these goods and services are cheaper in the world market, and everybody would buy their goods. Everybody would buy their goods and services. When everybody would buy their goods and services, they earn more foreign exchange reserves. Okay, they earn more foreign exchange reserves. Okay, now, for example, one Chinese yuan is equal to 0.50 US dollars. Okay, they keep this value constant. Okay, 1 yuan is equal to 0.50 US dollars. Okay. So they maintain. Okay, so who maintains this? Government of China. Any country which follows fixed exchange rate system, government maintains this exchange rate at a predetermined level. They want to keep it at $1 is equal to 0.50 yuan. Okay. Now, if anything, if you suppose the value of yuan is less, okay, the value of yuan is less than 0.50, then China will sell the dollars. Okay, and if the value is more, then Chinese government will purchase. Okay, so okay, it will sell dollars. The value is lesser, and purchase dollars when the value of it's more. Okay, when the value of it's more. Now, countries follow fixed exchange rate system. Okay, Fiji, Kuwait, Morocco, Libya, China. These countries follow fixed exchange rate system. Okay. Now, and these countries peg the value of their currency against major currencies of the world. What is the major currency of the world? Euro, pound, Japanese yen, Canadian dollar, okay, British pound, and Swiss franc. But China generally they peg their currency against US dollar also. Okay. Barring few countries, majority of the countries follow flexible and floating exchange rate system. Okay. 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 Now, country which follows fixed exchange rate system, if they deliberately reduce the value of the currency, okay, if the countries which follow fixed exchange rate system, if they deliberately reduce the value of the currency, then it is called devaluation. Okay. On the other hand, countries which follow fixed exchange rate system, if they increase the value of their currency, then it is called revaluation. Okay. So revaluation. So devaluation means decrease the value of their currency. Revaluation means increase the value of the currency. Now, countries which follow flexible exchange rate system or floating exchange rate system, where if currency value decreases, it's called depreciation. If currency value increases, it's called appreciation. Okay, so in the countries which follow fixed exchange rate system, if they decrease the value of the currency, okay, why they decrease the value of the currency? They want to increase their exports. Okay, so if they decrease the value of the currency, it's called devaluation. And if they want to increase the value of the currency, okay, from the current level, it's called revaluation. Both devaluation, revaluation done by the government of China, okay, or countries which follow fixed exchange rate system. Okay, but countries which follow flexible exchange rate system or floating exchange rate system, majority of the countries follow flexible exchange rate system, where if currency value depreciates, okay, decreases, it's called depreciation. If the currency value increases, it's called appreciation. Okay, this currency depreciation, appreciation happens without government intervention. Rupesh, see, base for exchange rate is US dollar. Okay, base for exchange rate is US dollar. Okay, so every country base their currency against US dollar. So we told no, majority of the countries in the world follow flexible exchange rate system and floating exchange rate system, where market force of demand and supply will determine the value of the currency. Okay, now, so if, okay, so what happened? Okay, I'll just explain using both. Okay, so all countries which follow flexible or floating exchange rate system, where demand and supply will determine the exchange rate of their currency. Okay, so these countries follow a band. Okay, what is a band? 72 to 76. Okay, they follow a band. Okay, 72 to 76. If tomorrow, that is 2nd May, it becomes 71, and 3rd May it becomes 70, and 4th May it becomes 69, then it is called appreciation of currency. Okay, appreciation of rupee, appreciation of rupee. Okay. On the other hand, okay, if rupee becomes 77, 78, 79, then it is called depreciation of, okay, depreciation of rupee. Okay, if rupee depreciates, RBI will sell the dollars. Okay, when RBI will sell the dollars, what happens? Demand for rupee increases. Demand for rupee, to purchase dollars you require rupees. So demand for rupee increases. Slowly rupee value will come down from 79 to 78, 78 to 77, 77 to 76. So within the band, see, within the band, okay, within the band. Okay, so similarly, if rupee becomes 71, 70, 69, it means rupee appreciated. Okay, RBI will purchase the dollars. RBI will purchase the dollars. When RBI purchases the dollars, what happens? Demand for dollar increases. Okay, and demand for dollar increases, demand for rupee decreases. So slowly value will come down. Value will come down to, okay, slowly rupee will come back to the normal level. Okay, so what is the normal level? 69, it becomes to 70, 70 to 71, and 71 to 72. Repeat again. Okay, I explain the whole thing again. Okay, so band is there. RBI keeps the band. Okay, every central bank keeps a band. Okay, band is what? You know, kabhi you go to doctor, no, doctor keeps the temperature, right? Or your fever is more than 101, so you got the fever. Your fever is 97, there is no fever. So RBI, every central bank keeps a band. Okay, so Indian RBI also keeps a band. Okay, why band? To monitor value of rupee in terms of dollars. 72, 76 is the band. Okay, if rupee becomes, okay, rupee becomes 77, 78, 79, then it is called rupee depreciation. Okay, if rupee is depreciating, RBI will sell the dollars. Okay, RBI will sell the dollars. To buy the dollars, you require rupees. Okay, so people, investors, everybody want rupees. So what happened? Demand for rupee increases. Demand for rupee increases. Slowly, rupee will come back from 79 to 78, 78 to 77, 77 to 76. So 76 our band. Okay, clear? Clear, guys? Okay, okay. So other hand, if rupee becomes 71, 70, 69, which means rupee appreciated against the US dollar. US. Okay. Rupee appreciated, RBI, what does RBI do? RBI will purchase the dollars. To purchase the dollars, RBI demand for dollar increases. Demand for dollar increases and demand for rupee decreases. So slowly value will be back from 69 to 70, 70 to 71, and 71 to 72. So within the band. Clear, guys? Ayush, when rupee is depreciating, I want to bring back the value of rupee to 72, 76. That's why I sell the dollars. When I sell the dollars, okay, how you buy dollars in India? You require rupees. Demand for rupee increases. Demand for rupee increases. Value will come back to the 76 level. 76 level. Okay, when rupee is depreciating, RBI will sell the dollars. To buy the dollars, India you require rupees. So everybody wants demanding rupees. Why? They want to buy dollars from RBI. So demand for rupee increases and demand for dollar decreases. So rupee value will come back to 76. Similarly, if rupee is appreciating, RBI will purchase the dollars. Okay, when RBI will purchase the dollars, okay, and demand for rupee falls and demand for dollar increases, slowly rupee value will come back to the 72 margin. Mansha, on paper we follow flexible exchange rate system. Okay, but in reality what we follow is called dirty float. Dirty float means on paper we say demand supply will determine the value of the currency, but actually we follow a dirty float by keeping a band. Okay, as long as rupee value is within the band, we'll keep quiet. In case rupee depreciates, rupee appreciates beyond this band, RBI intervenes. On paper only we are saying flexible exchange rate. In reality, we follow every central bank in the country which is following flexible exchange rate system. They follow a dirty float or semi-float. Okay, where RBI intervenes if rupee depreciates too much and rupee appreciates too much. Ayush Manish Agrawal, answer to question. Hitesh, flexible exchange rate system means what? Demand and supply will determine the value of the currency on daily basis. Clear? Okay, so they follow a dirty band 75 to 76. I'll keep 76 only so that you understand better. 75 to 76. Okay, if it becomes 76, 77, then it is called depreciation. And then it becomes 69, 79, it's called rupee appreciation. Then RBI will intervene. Okay, so when it becomes 76, 77 depreciation, RBI will sell the dollars. Okay, when it becomes 68, 69, 68, 67, then it is called rupee appreciation. RBI will purchase the dollars. Then it is called soft peg exchange rate policy. Okay, if RBI intervenes, okay, on paper they say they follow flexible exchange rate system. In reality, they follow a band. That band is called dirty band or semi float, where RBI intervenes in exchange rate of rupee to see that rupee value within this range only. Okay, so if RBI sell the dollars when rupee depreciates, if RBI purchase the dollars when rupee appreciates, that's called soft peg exchange rate policy. Soft peg exchange rate policy. Okay, now hard peg exchange rate policy. Okay, so who follows hard peg exchange rate policy? Countries which follow fixed exchange rate system keep their value of the currency unchanged. Okay, so central bank will intervene only as and when required. So fixed exchange rate system, central bank intervenes in the value of their currency. It is called hard peg exchange rate policy. Okay. Okay. Explain again. Okay. Okay. So all central banks, they say they follow flexible exchange rate, but they follow dirty float or semi float. Okay, so they say 70 to 76 is the band. Okay, if value of rupee becomes 71, 69, daily is determined. No, if it becomes daily value determines. So today, tomorrow it becomes 71. Day after tomorrow it becomes 70. Okay, or it becomes 69, or it becomes 68. Day after tomorrow, everyday value is determined. No, so then it is called. Then it is called rupee appreciation. Or if value of rupee becomes 77 tomorrow, day after tomorrow 78, and Wednesday it becomes 79, then it is called 80, then it is called rupee depreciation. I'm there. Yeah. See, if rupee appreciates, why rupee appreciates? Value is determined daily basis. If rupee appreciates, RBI has to intervene. Okay, so rupee appreciate, RBI. What does RBI do from foreign exchange reserves? It takes the dollars and sells in the market. Okay, when RBI sells the dollars, to buy dollars you require rupees. Demand for rupee. Okay, demand for dollars increases, demand for rupee decreases. Okay, because RBI is selling dollars, right? So if rupee becomes 60, 71, 70, 69, 68, it's called rupee appreciation. Then what does RBI do? RBI will purchase the dollars. RBI will purchase the dollars. Okay. Then RBI purchase the dollars, demand for dollar increases and demand for rupee decreases. So RBI will sell 3-4 days. Okay. Because RBI wants to bring back the value of rupee to 72. So RBI will sell dollars today, tomorrow, day after tomorrow, okay, in foreign exchange market. Okay, so demand for dollar increases and demand for rupee falls. So value comes back to 72. If rupee becomes depreciated, right? So RBI will sell the dollars. Okay, so to purchase the dollars, you require rupees. Demand for rupee increases and demand for dollars decreases. Value will come back to this level. Mukta Vyas, on paper, all countries, they say flexible exchange rate system, but they follow flexible exchange rate system where demand and supply should determine the value of the currency, but they follow dirty float, semi float, where RBI keeps on interfering in the value of the currency to see that value does not appreciate much, does not depreciate much. Okay, clear, guys? Clear, guys? Okay, now peg means fixed. Okay, pegging the value of the currency. Okay, I'm pegging the value of Chinese currency in terms of dollar. That's why it's called pegged currency. Okay, pegged system. Fixing the value of the currency is called pegged system. Now, advantages of fixed exchange rate system. Okay. Okay. Now, why China and Libya, all these countries, why they follow fixed exchange rate system, right? So, and Fiji, why they follow fixed exchange system? Okay. Now, when I follow fixed exchange rate system, no I'm keeping the value of the currency constant, so I'm avoiding currency fluctuations, right? Currency fluctuations, and there is no exchange rate risk. Okay, and no transaction cost. Okay, so it's an advantage. Okay, now if I keep the value, if I'm pegging the value of the currency, what happened? Everybody would buy my goods and services because everybody knows the exchange rate of Chinese yuan with other country currency. So everybody knows their value. So everybody would buy goods from China because the currency value is artificially low. They are aware of the currency value. So it ensures free trade, smooth trade for China, and investors also would like to invest in this country where currency is stable. Okay, investors would like to invest in those countries where currency value is stable. Okay, so, and if exchange countries which follow fixed exchange rate system, the currency value is stable. Currency value system is stable. Currency value system is stable. Okay, currency value system is stable. And fixed exchange system, what happens? It imposes discipline, okay, on the monetary authority. Okay, so country value is fixed. So whatever goods they're going to import from outside China, they are not expensive because okay, so the country would like to have a lower level of inflation rate. Okay. And country which follows fixed exchange rate system, their constant value of the currency for longer period of time, it increases the credibility of the value of the currency. Okay, and if country like China's government, if they follow fixed exchange rate system, they can increase trade and investment, and trade and investment will be more in those countries. Clear, guys? Okay, I'll explain again this thing. You're finding it problem. See, try to understand. Try to understand me here. See, there are two types of exchange rate regime: fixed currency, fixed exchange rate system, flexible exchange rate system. Fixed exchange rate system means where currency value is pegged against US dollar. Okay, keeping artificially their currency low because they want to take care of their exports. Okay, but majority of the countries in the world follow flexible exchange rate system. Flexible exchange rate system means demand and supply should determine the value of the currency. Yes, demand and supply will determine the value of the currency. Okay, every day. But to be safe side, these countries they follow dirty float. Okay, what is 72-76 band? Okay, 72-76 band they keep, okay, as to monitor what? To monitor value of rupee in terms of dollars. In terms of dollars. Okay, if value of rupee becomes 77, 78, 79, 80, which means rupee appreciating against the dollar. Rupee is depreciating. Rupee is depreciating against the dollar. Because how are you able to say that value came out of 76, right? 77, what should be 76? Value becomes 77, 78, 79. It means rupee is depreciating, okay, which is not good for the economy. So what does RBI do? From foreign exchange reserves, they take dollars and they sell dollars. Okay, where they sell dollars? Where? In India. When they sell dollars, okay, so to buy dollars, you require rupees. So demand for rupee increases. Okay, demand for rupee increases and value will come down from 80 to 79. Okay, again RBI will sell the dollars. Value will come down to 79 to 78. Again RBI will sell the dollars. Value will come down to 77 to 77. Again RBI will sell the dollars. 3-4 days. Value will come down to 76. So within the band. So 76 is within my band. Clear? Clear, guys? Now try to understand. So now 76 is within my band. So what I'll do, the value of rupee becomes 71, 70, 69, 68, 67, which means rupee appreciated against dollar. So what does RBI will do? RBI will purchase the dollars. Okay, RBI will purchase the dollars in the market. Okay, so when RBI purchase the dollars, demand for dollar increases. Demand for dollar increases. And value of rupee will come down from 67. RBI will purchase tomorrow also. 66, 66, 60, rupee will come down from so 67. Again, RBI will purchase 68, 69, 70. Every day RBI will purchase. How long RBI will purchase? Till the value comes down to what value? 70. Okay. When RBI purchases the dollars, okay, demand for dollar increases and demand for rupee decreases. Demand for rupee decreases. Okay. Demand for dollar increases and demand for rupee decreases. So slowly value of rupee will come down from 67, 68, 69, 70, 71, 72. So 72 is within my band. All countries will do. US, Germany, France, Italy, Australia, Sri Lanka, Pakistan, all countries, they say we are following flexible exchange rate system, but what they follow is dirty float or semi-float. Clear? Okay. Now, okay. If rupee appreciates, rupee appreciates too much. Rupee appreciates, what will happen? Our exports will become costly and imports will become cheaper, and so of what? Of goods and services. So it will lead to current account deficit. Okay. If rupee depreciates, appreciates, exports will become costly, imports will become cheaper, and imports will become costly. Imports will be costly. It will lead to current account surplus. If current account surplus is there, if it lead to current account deficit. Current account deficit means investors will take out their money from stock market. Rupee depreciation is there. Okay. If current account deficit, the investor will take out their money from stock market, then rupee will depreciate. Okay. If current account surplus is there, okay, then investors will invest in stock market. Okay, rupee will appreciate. So that's why we don't want rupee appreciation. We don't want rupee depreciation. Clear, guys? You understood this? If rupee appreciates, exports will become costly, imports will become cheaper. Of what? Goods and services. It will lead to current account deficit. If current account deficit is there, what investors will do? Investors will take out the money from stock market and go to other countries, because countries in the current account deficit, no investors want to keep their money. So rupee will depreciate against the dollar. If rupee if rupee depreciates, exports will become cheaper, imports will become costly, it will lead to current account surplus. If current account surplus is there, investors take out their money from US stock market, start investing in India, rupee will appreciate against the dollar. So we don't want neither rupee appreciation nor depreciation. We want stable currency. So how to ensure stable currency? Okay, to stable currency through dirty float 72, 76 or semi float. 72. Clear, guys? No. If exchange rate is determined by market force of demand supply, then it is called flexible exchange rate system or floating exchange rate system. But majority of the countries follow flexible exchange rate system, which is considered to be efficient and transparent. Okay. Now, on paper they say we're following flexible exchange system. What they followed is called dirty float or semi float. Okay. So why majority of the countries they follow flexible exchange system? Because it gives independent monetary policy. Okay. Now, and countries which follow flexible exchange rate system, what they do? Okay. So countries which follow flexible or floating exchange rate system, okay, it gives them what? Independent monetary policy. Okay, independent monetary policy where RBI central bank will follow the policy, will follow monetary policy. If country follows fixed exchange rate system, there is no independent monetary policy. Okay. Now, second thing is what? Our central bank, RBI or central bank can influence the exchange rate. Can influence the exchange rate. How? By buying or selling dollars. Okay, buying and selling in dollars, and RBI can influence the exchange rate, right? RBI can influence the exchange rate. RBI can influence the exchange rate. Okay, okay. So if I think that rupee value is depreciating, I can protect the value of rupee. Okay, if rupee value is high, I can bring down the value of rupee. Okay, so I can manipulate the value of rupee. Okay, so if rupee value is high, so if rupee value is high, nobody will buy India's exports. I'll bring down the value of rupee. Okay, I'll bring down the value of rupee. Okay, if rupee value is high, I'll bring down the value of rupee. So see that India exports become cheaper in the world market. Okay, clear? So I can influence the value of currency, okay, according to the needs of the economy, according to the needs of the economy. So countries which follow flexible exchange rate system, no need for central bank to interfere, okay, because market force of demand supply will determine the value of the currency, but that is not true, right? This what theory paper textbook says like this. Okay, no obligation on the part of central bank to interfere in the value of the currency because they follow flexible exchange rate system. But in reality, RBI maintains a dirty float. Okay, and if the value of rupee is appreciating, depreciating, using foreign exchange reserves, RBI will try to bring back the value of rupee according to within the dirty float. Okay. But the problem with the flexible exchange system is the exchange rate is so volatile. Okay, it fluctuates so rapidly. Okay, and it involves with a lot of uncertainty. Okay, it involves a lot of transaction cost, premium cost. Okay, and so many assets are traded. Indian people buy equity, bonds, land outside India. If uncertainty of exchange rate is created, then it will create a lot of problems in the purchase and selling of the assets. Okay, in short, fixed exchange system bring in more currency and monetary stability. Okay, so China has 3 trillion foreign exchange reserves now because they follow fixed exchange system. It bought more foreign exchange, 3 trillion foreign exchange reserves and monetary stability, and credibility. Okay, but it lacks flexibility. Okay, it lacks flexibility. Okay, so they keep the currency value artificially low. It lacks flexibility. On the contrary, countries which follow floating exchange system has greater flexibility but less stability. Okay, so less stability. Clear? Any doubts? Yes, Mukta, majority of the countries follow flexible exchange rate system where value of currency determined by demand and supply on paper. Okay, textbook में वही लिखते हैं, but actually US, Pakistan, Sri Lanka, every country follows dirty float, semi float. Clear? Okay, foreign exchange market. Okay, so foreign exchange means currency market. Okay, where all global currencies are being traded. Okay, and value of the currency also determined. Okay, so who are all the participants? Central bank, commercial bank, governments, foreign exchange dealers. Okay, and multinational companies and that engage in international trade and investments, and non-banking financial institutions and asset management. Okay, asset management firms, insurance companies, brokerage, arbitrage, speculators. They are all the participants in the foreign exchange market. Mansha, yes, Mansha, stability is more important than flexibility. You're right. But it's not visible. Now visible? Mansha, stability is more important for China because they follow fixed exchange rate system. Okay, so because they depend upon export oriented economy. For country like India, okay, we require more flexibility because we don't depend upon export sector alone. Rupesh, I'm not able to understand the question. So foreign exchange market we're discussing. Okay, where how foreign exchange market is a currency market. Okay, where we determine the value of the exchange rate of each currencies. Who are all the participants? Central bank, commercial banks, government, foreign exchange rate dealers, multinational companies, okay, that engage in international trade and investments. Okay, and apart from this, we have non-banking financial institutions such as asset management firms, insurance companies, brokerage, arbitrage, and speculators. Okay. Okay, now what is the role of central bank? Central Bank of India is to see every Central Bank of India country is to ensure that rupee value does not appreciate much, does not depreciate much. Okay, so they keep a band. As long as rupee value within the band, they'll keep quiet. They will keep quiet. If rupee value is going out of the band, they'll intervene in the foreign exchange market. Okay, because appreciation, depreciation will create lot of havocs. We discussed now. We discussed if rupee appreciates, we have a problems. If rupee depreciates also, we have a problems, right? Now, commercial banks also participate in the foreign exchange market. Okay, either they participate directly or on the behalf of their client. Okay, on behalf of their client. Okay, and okay, they also on the behalf of their client or directly, they also involve in foreign exchange market. Okay, so they participate. Okay, they operate as a speculators, because if there is any, they also buy and sell the currency like arbitrage or both. Okay, but okay, generally commercial banks are involved in foreign exchange market. They also take the opportunity when they also buy the value of the currency, when the value of the currency low, and sell it like arbitrage or like speculators, like brokers. Now, foreign exchange brokers, okay, foreign exchange brokers, they participate in the market as intermediaries between different dealers or banks. Now, you know, arbitrage, we know that, no, they make profit, right? But by discovering the price differences in, okay, between the pairs of currencies, okay, different, okay, the arbiters also try to make a profit by discovering price differences between the pairs of currencies with the different dealers or banks. Speculators, okay, speculators now who are bulls and bears also are deliberate risk takers who participate in the market to make gains which result from unanticipated changes in exchange rate. Okay, speculators, they also buy and sell the currency. Other participants in the exchange market are individuals who form only very insignificant fraction. Okay, very small individuals only participate in this. Okay. Okay. In foreign exchange market, there are two types of transactions. Okay, current transactions which are carried out in the spot market, and exchange involves immediate delivery. Okay, as per the current exchange rate. And future transactions where contracts are agreed upon to buy and sell currencies for future delivery, which are carried out in forward market or future market. Okay, we have a spot delivery foreign exchange market, or forward or future markets. Okay, so spot market where delivery, where exchange involves immediate delivery. Okay, in future transactions where contracts means what? Buyer and seller agree to buy upon sell currencies for future delivery, which are carried out in forward or future markets. Okay, the functions of exchange market. Okay, now highly liquid market, right? So foreign exchange market is the most liquid market. Okay, okay, because various currencies of the world are being traded there, and market transparency. Okay, now people are involved in trading of foreign currencies, like a central bank, commercial bank, arbitrage, speculators. Okay, everybody, they have complete access to the market information of different currencies. And dynamic market, you know, value of the currency keeps on changing, right? Okay, for every second, for every hour, and it operates 24 hours. Okay, it operates 24 hours. Okay. See, brokers participate as intermediaries between different dealers and bankers. Ayush Agrawal, brokers participate as intermediaries between different dealers and banks. But arbitrage purpose is to make profit, okay, by discovering price differences, okay, between pairs of currencies with different dealers or banks. Okay, not much difference. Both are less come under the same slight difference. Any doubts? Let me take you the discussion. So I give an example of exchange rate here. Then we discuss what is exchange rate. We discuss what is nominal exchange rate, and we discussed what is real exchange rate. And we discussed real exchange rate formula here. Nominal exchange rate into price of domestic goods to price of foreign goods. E is equal to P into P asterisk. Okay. Real exchange rate depends upon nominal exchange rate, ratio of price level of domestic goods and foreign goods. Then we discussed what is nominal exchange rate, real exchange rate into price of foreign goods to price of domestic goods. Okay. Now we discussed direct quote and indirect quote. Real effective exchange rate and cross rate we discussed. And I told you, most of the countries follow flexible exchange rate system and floating exchange rate system. And only few countries, Fiji, Kuwait, Morocco, Libya, China, they follow fixed exchange rate system, where the value of the currency is pegged against dollar by government of the country. Okay. And flexible exchange rate system, where the value of the currency is determined by market force of demand supply. Okay, but in reality they follow dirty float or semi float. They fix the value of the currency against dollar and under a band 72 to 76. Okay, this band is maintained to see that rupee does not fluctuate beyond this band or does not appreciate beyond this band, and RBI will intervene. If rupee is depreciating, RBI will sell the dollars. RBI will sell the dollars, and if rupee is appreciating, RBI will purchase the dollars. Okay, so and fixed exchange rate system, if the currency value is decreased, it's called devaluation. If currency value is increased, it's called revaluation. But in countries in countries which follow flexible exchange rate system, if the value of the currency is decreased, it's called depreciation. If the value of the currency is increased, it's called appreciation. Okay, so if in flexible exchange rate system, RBI intervenes in the market. If rupee depreciates, appreciates, it's called soft peg. And the countries which follow fixed exchange rate system, if RBI intervenes, that is called hard peg exchange rate policy. Now we discussed advantages of exchange rate, and we discussed advantages of flexible exchange rate system. Flexible exchange rate system. Okay, then we discussed foreign exchange market. Okay, forex market where that determines the exchange rate for various currencies of the world. Okay, on daily basis. Okay, who are all the participants? Central bank, commercial banks, government, foreign exchange dealers, multinational companies that engage in international trade investments, non-banking financial institutions such as asset management firms, insurance companies, brokers, arbitrage, and speculators. Okay, so central bank also will intervene in the and commercial banks, foreign exchange brokers, okay, and arbitrage and speculators, other participants. So there are two types of transactions: spot market, where immediate delivery of the currency happens, exchange rate happens; and future transactions, where contracts agreed upon to buy and sell currencies for future delivery, which are carried out in forward or future markets. Clear, guys? Clear? Any doubts? Hello? Or break, sir. We'll take a break. Welcome back after the break. See, in foreign exchange market, there are two kinds of transactions happens. Okay, spot market and forward and futures. Spot market means okay where transactions are carried out in the spot market and exchange involves immediate delivery. Okay, you need to make a payment. Okay, but with regard to future contracts, okay, where contracts agreed upon to buy and sell currencies for future date. That's why it's called forward and future contracts. Mukta see, I gave a brief explanation who are all the participants in the foreign exchange market. Okay, it is there in your CA material. Okay, just verify. Okay, you need to know. You should know what is foreign exchange market. Mukta Vyas, previous class PPTs have been emailed to Econ and they're going to upload the content. Okay. Okay. Now let us okay. So determination of exchange rate. Determination of exchange rate. How it is determined? Demand and supply will determine. Okay. Now, who is demanding dollars? Who is demanding dollars? Indians are demanding dollars. Indians are demanding dollars. Why Indians are demanding dollars? To buy equity, bonds, land, etc. For education purpose. For education purpose. Or to set up factory in US. Okay. Or Indians need dollars for tourist visit to US. Okay. Now, who is supplying dollars? Okay. Americans or US is supplying dollars. We demand dollars for imports also, right? We didn't write that. We demand dollars for import of goods and services. Okay. Now, who is supplying dollars? Who is supplying dollars? US. Why they're supplying dollars? They want to buy Indian equity, bonds, or they want to set up factory in India. Okay, or they want to buy land. Okay. Okay, they want to buy land. Okay. Okay, they want to buy land. Okay, and or they visit as tourist in India. Clear? Same thing I'm discussing here. Okay, same thing I'm discussing here. Look at here. See, For foreign education, we require dollars. Now, you want to set up factory, so then foreign direct investment. We require bond equity, again we require dollar. Tourism, buying foreign goods and services. Imports ke liye we require dollars. So how do we get dollars? Exports of goods and services. Tourists visiting India. We buy American company shares and bonds, or we set up factory in US. Okay, try to follow me here. Right, look at here. Okay, now what is FDI? You need to understand here. Okay. So Uber, Amazon, they are the American company, US companies in India. So that is foreign direct investment. Similarly, Infosys in US, that is also FDI. HDFC Bank in US, that is also FDI. Okay. So we so this is your y-axis, this is your x-axis, this is your demand curve, this is your supply curve. Both are equilibrium here. Okay, so this is your demand curve, this is your supply curve. So 75 is the okay, $75 are being supplied. Okay, and this is y-axis, right? So y o x. Okay, now $75 are supplied. How much quantity of dollars supplied? At 75 rupees. OQ quantity of dollars are supplied at 75 rupees. This is okay. So today OQ quantities are being supplied and demanded at 75 rupees. Okay. Now this is how dollar price is determined every day, right? Today. So tomorrow it could be, so tomorrow what happened? Suppose this is how determined, right? This is how demand supply will determine the dollars. Tomorrow, say for example, demand for dollars has increased. Demand curve will shift to the right. See, rupee got depreciated. Okay, because demand for dollars has increased, resulting in depreciation of rupee. So okay, demand curve shifted from D to D1 because demand for dollar increases. Okay, supply of dollars remains constant. Okay, suppose demand of dollars increase, then you see Demand for dollar increases and supply of dollars remains constant. Rupee depreciate against the rupee depreciated 75 to 77. Clear? Okay. Clear, guys? Now let us take this diagram. Erase this diagram. Okay. Again, we'll draw demand curve. Demand curve. So demand curve, supply curves. ₹75. Okay. How much quantity being supplied, demanded? OQ quantity being supplied. This is Y, O, X. Okay. This equilibrium. Okay. Now demand is constant, supply has increased. Supply has increased. Demand is constant and supply has increased. So supply has gone up from S1 to supply of dollars has increased. Demand has become constant. If demand is constant, supply has increased, what would happen? Then rupee would appreciate. Rupee appreciated to 73. Because demand is constant, supply has increased. Supply of dollars increased. This is how rupee appreciation, depreciation. Clear? Okay. It's clear? Demand. So demand for dollars. This is supply for dollars. Both are equilibrium. Okay. This is your demand. This is your supply. So what is the value? $75 or 75 is the value of dollar. How many dollars are supplied? Say for example, okay, you can say even working quantity being dollars, supplied demanded at 75 rupees. Right now, supply of dollars is constant. Okay, only working quantity being supplied every day. Suddenly, what happened? Demand for dollars has increased in India. Oh, incorrect. Sorry. This is your demand curve. and this is your supply curve. This is your demand curve. So what is the value of the 75? Okay, how much quantity being demanded? Now this is your demand curve. This is your supply curve. Right? Now supply of dollars is constant. Supply of dollars is constant. Demand for dollar has increased. Okay. OQ quantity, people want more dollars. Okay. See. So people want more dollars. Okay. If people want more dollars, okay, rupee would depreciate against the dollar. Rupee would depreciate against the dollar. Yes, Ayush Agrawal. Downward is demand curve, upward is supply curve. Okay. Okay. So look at it. You see here, demand for dollar has increased. You see that rupee got depreciated. You see here, demand is constant, supply has increased. Supply of dollars increased. Rupee value got depreciated. Okay. So here the value you see determine demand and supply. Here supply is constant, demand is increased. So rupee value got depreciated. 70 to 75. Here demand is constant. Supply of dollars has increased more. So rupee got appreciated. Rupee got appreciated. Clear? 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 So demand supply every day it is determined like this. So here what happened? Demand has increased. Demand for dollars increased. So rupee got appreciated. Here supply of dollars is increased. Demand is constant. So rupee got appreciated. Okay. So why rupee appreciation is bad? We discussed, right? Rupee appreciation bad means exports becomes cheaper and imports becomes costly. Okay. Okay. It may lead to current account surplus. Okay. Current account surplus means more capital will come in, resulting in rupee appreciation. Third, the, the cost. Okay. So exports become costly. Sorry. Exports become costly and imports become cheaper, and it may lead to current account deficit. So capital will fly out of India, because of current account deficit. So rupee will depreciate against dollar. Okay. Okay. Second reason why rupee depreciation is bad. Exports becomes cheaper and imports become costly. Exports become cheaper, exports becomes cheaper, imports becomes costly. Exports become cheaper and imports become costly. It may lead to current account surplus. So capital will fly into India. So resulting in rupee appreciation. Same thing we discussed in PPT also. So same thing we discussed here. So look at this. Look at this slide. Why rupee depreciation bad? Exports will become expensive, uncompetitive. Imports become cheaper. When imports of goods and services more than exports of goods and services, they may lead to current account deficit. Why depreciation bad? Exports become cheaper, imports become costly. When exports of goods and services more than imports of goods and services, it may lead to current account surplus. So dirty float we discussed. Okay. 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 Ayush. See. If rupee depreciates, exports cheaper, imports becomes costly. Okay, it may lead to, it means what? Exports of goods and services greater than imports of goods and services. Okay, so it means current account surplus. So if current account surplus means what? Investors will take out their money, start investing in India, rupee will appreciate against the dollar. If rupee appreciates, exports becomes costly and imports becomes cheaper. Imports become cheaper. Okay. So it may lead to, it means what? Imports of goods and services is greater than exports of goods and services. So it leads to current account deficit. If current account deficit is there, what? Investors don't keep money in the stock market. They take out their money. So rupee will depreciate against the dollar. Clear? I'm not saying Mukta Vyas, you will not understand what I'm saying. You are not understanding. If current account surplus is there, rupee will appreciate. If current account deficit is there, rupee will depreciate. You are not understanding what I'm saying. If current account surplus is there, yes, RBI will intervene. That's a different thing, Manisha. I'm explaining before RBI intervenes. If there is a current account surplus, rupee will appreciate. Then RBI will intervene. That will happen later. Okay, that will happen later. I'm saying the process. If current account surplus, rupee will appreciate. Then RBI will intervene. If there is a current account deficit, rupee will depreciate. Again, RBI will intervene. Okay, RBI intervention happens later. I'm explaining the causes. I'm saying that both appreciation and depreciation of rupee both are bad. Both appreciation, depreciation of rupee both are bad. I'm explaining both why both rupee appreciation, depreciation are bad. Okay, if there is a current account surplus, investors will take out their money, invest in India, rupee will appreciate, then RBI will intervene. If there is rupee depreciates, then there will be current account deficit. Investors will take out their money, rupee will depreciate against the dollar. Again, RBI will intervene. Okay. Okay. Factors determining exchange rate. Okay. First, net capital flows. Okay. So today, FDI and FII, foreign institutional investment, enter into India, say for example, 500 crores. And today, FDI, FFI moved out of India. Say for example, 200 crores. So net flow is how much? 300 crores. Plus 300 crores. Okay. So everyday capital comes into India. capital goes out of India. If net flow is 300 crores, rupee will appreciate. Rupee will appreciate against the dollar. Okay, so net capital flows. Okay, everyday capital moves out of India. Okay, FDI, FFI. Everyday capital comes into India. FDI, FFI. Okay, if capital net flow is positive, rupee will appreciate against the dollar. Okay, second reason. Second reason is short-term interest rate. Short-term interest rate. Okay, if short-term interest rate or repo rate in India is 6% and US it is 1%. If repo rate short-term interest in India, you know what happened? Investors, what they do, investors will invest in India. Investors will prefer to invest in India by taking out their money from US market. So then what happens? Rupee will appreciate. Well, rupee will appreciate against the dollar. Because repo rate is called benchmark rate. If repo rate is high in India, investors what they do are returns more in India because repo rate is very high. They take out their money from the stock market and invest in India. When they invest in India, they convert rupees into they convert dollars into rupees. They demand rupees. So demand for rupee increases. So rupee will appreciate against the dollar. Okay. Third one is purchasing power parity. Purchasing power parity, PPP. Okay, so a pair of shoes. A pair of shoes. Okay, pair of shoes. Okay, okay. We're taking pair of shoes in Britain and India. Okay, I'll explain for this. See, okay, so a pair of branded shoes is 400 rupees in India. Same shoes 5 pounds in England, right? So 80 into 5 is 400. Okay, okay. So this is what I'm explaining here. Okay, so see, pair of shoes, if it's 400 rupees in India, it should be 5 pounds in England because 85s are 400. Okay, now, if the same shoes is if the same shoes cost 3 pounds in UK, then what happens? Indians would like to buy the shoes in UK than buying it in India, resulting in rupee appreciation and appreciation. Okay, so they find if Indians find the same pair of shoes. Yes. A pair of shoes in India. And I'll explain this. Okay. In India, price of shoes is 400. Britain, it is 5 pounds. Okay. How are you able to say 5 pounds? 80 into 5. 1 pound is equal to 80 rupees. So 400 rupees. Suppose in Britain, it is only 3 pounds. What Indians will do? Indian will prefer to buy in Britain and than India because 3 pounds only. So they are required to pay less. So what they do? So demand for pound increases and demand for and rupee will depreciate. Okay. So in case the pair of shoes is 5 pounds, there is no problem in exchange rate. In case pair of shoes become 3 rupees, 3 pounds, 3 means 240 rupees. Same shoes would cost in US 240 rupees. What Indians will do? Indians would like to import from US. So demand for pound increases and rupee will decline. So purchasing power parity. Now short-term interest rate. Inflation. Okay. So inflation is third next risk. Okay. So inflation. Inflation is the fourth risk. So assume in India inflation is 10%. US inflation is 2%. What investors will do? Inflation rate, since inflation rate is high in India, investors will take out their money from stock market. Okay, and because inflation rate is high, so returns are very low in India. So investors will take out their money in stock market and start investing in US. So when investors take out their money, rupee will depreciate against the US dollar. Okay. Fifth one is fiscal deficit. We discussed fiscal deficit, what government earns minus what government spends. If fiscal deficit is high in India, investors will take out their money from stock market and start investing in US. And current account deficit. If current account deficit is high in India, again investors will take out their money from stock market and start investing in US. So again rupee will depreciate against the dollar. So capital inflows. If you will take net capital inflows, if net capital inflows into India high, rupee will appreciate against the dollar. Purchasing power parity, if there is a variation in purchasing power parity, again rupee value will undergo change. If repo rate is high in India, low in US, again capital inflow will come into India, rupee will appreciate against the dollar. If inflation rate is high in India is high, low in US, investors will take out their money from stock market and start investing, because inflation high means returns are more. So all investors don't like to keep their money in India stock market. They'll take out their money because inflation rate is high. They start investing in US, and then rupee will depreciate against the dollar. If country has a high fiscal deficit, your country has a high fiscal deficit, what government earns minus what government spends, okay, their investors will take out their money from stock market and start investing in US dollars. So rupee will depreciate against the dollar. If country has a huge current account deficit, again investors take out their money in stock market, start investing in US. So okay, so appreciation of currency. So impact of exchange rate fluctuations on Indian economy. Okay, and it plays major role in international trade of exports imports. Appreciation of currency may hurt exports and kind on imports. If currency depreciates, exports become cheaper and imports become costly, and okay, and if currency depreciates, cost of repayment of debt will go up for corporates and government. If currency depreciates, cost of imported raw materials would go up for developing countries. Okay, and if currency depreciate, okay, and the cost of import of oil and gold will go up for a country like India. If currency depreciates, then foreign goods becomes expensive for India. Okay, and Indians would like to import goods from outside the country than buying it in India. Okay, so if currency depreciates, foreign goods become expensive, and so people would like to buy the goods, prefer to buy domestic goods. Okay, so resulting in expansionary effect. Okay, so what happens if a rupee depreciates, Indians would like to buy goods in India, they can't buy outside. It will cause expansionary effect, increase in demand for domestic goods, increase in output, employment, and income and investment. Okay, if rupee volatility is high, investors will take out their money investment, and because they don't want to keep in the stock market. Okay, and if exchange rate fluctuations the exchange rate fluctuations are very high, difficult for the firm to forecast its revenue and cost. And if rupee depreciates too much, many of the firms don't want to hedge their currency. They don't want to hedge the currency because hedging is a very costly affair. Okay, and if rupee is depreciating, cost of repayment of debt will go up. Okay, and there is a pressure on the RBI to ensure proper repayment. If rupee depreciates, cost of inflation will go up, right? India imports oil and gold, so imports are part of the CPI. Imports will go up. Okay, and if rupee appreciates, exports become expensive, imports become cheaper. Okay, and exports become expensive, imports become cheaper, resulting in current account deficit. Okay, so depreciation of currency may help India to contain imports of gold and oil and other raw materials. Okay, and it may help India to control trade balance and current account deficit. If rupee is depreciating, India will have to use precious foreign exchange reserves to protect the value of rupee. Okay, so these are the points we discussed. True or false? Mukta Das, your question is not clear. All flexible exchange rate regime follow dirty float. True. If rupee depreciate, RBI purchases the dollars. If rupee depreciate, RBI will sell the dollars. False. Real exchange rate is low. It means foreign goods are expensive. True. Purchasing power parity determines the exchange rate. True. Repo rate is linked to exchange rate. True. So these are the essay questions. Discuss the different types of exchange rate regimes. How is the exchange rate is determined under floating exchange rate system? How changes in exchange rate affect the home country? What are the various determinants of exchange rate system? Differentiate between nominal and real exchange rate system. How do you determine the strength of the currency? Write a note on forex market. Discuss the advantages of fixed and flexible exchange rate systems. Real exchange rate considers A. Relative price of goods, domestic good, relative price of foreign goods, relative price of essential good, relative price of domestic goods and foreign goods. 1D. If real exchange rate is high, foreign goods are cheaper and imports will rise. Domestic goods are cheaper and exports will rise. Imports will fall. So foreign goods cheaper and imports will rise. 2A. 3. Under floating exchange rate system, exchange rate is determined by the value of currency pegged. Market forces will determine C. IMF, D. World Bank. Okay, the value of the currency determined by demand and supply. If rupee is depreciating against the dollar, RBI will sell the dollars, RBI will cut the repo rate, government prints more money, RBI will purchase the dollars. 3B, RBI will sell the dollars. Which of the following is not determinant of exchange rate? A. Inflation, B. Capital inflows, C. Repo rate, D. Consumption. 5D. Consumption. If real exchange rate is high, it might lead to A. Current account deficit, B. Fiscal deficit, C. Current account surplus, D. Increase in foreign exchange reserves. 6. A. Current account deficit. If the rupee is appreciating against the dollar, then RBI will purchase the dollars, will increase the repo rate, will sell the dollars and ensure capital flies out. 7. A. RBI will purchase the dollars. Which of the following statement is false with regard to rupee depreciation? Builds pressure on corporate and government debt payment, capital flies in, pressure on foreign exchange reserves, imports become costly. Okay. Which of the following statement is false? Rupee depreciate, capital flies out. So capital flies in. Incorrect. The term revaluation is applied to fixed exchange rate system. Which of the following statement is false? Majority of countries follow fixed exchange rate system. The term devaluation applies to fixed exchange rate. RBI wants Indian companies to hedge their currency. Dirty float is generally followed by countries with fixed exchange rate system. 10 is D. So Mukta has consumption, domestic consumption. Domestic consumption here. Yes, Hitesh, you can write my notes. Thank you, students. Thank you very much. I made a nice PPT. Go through the PPT. Okay. Are you there? Hello? Sir, are you there? Hello? Sir, are you there, sir? Hello? 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 Yeah.